Good evening. My name is Selena Joffrey, and I'm the Director of Business and Policy at Asia Society Texas Center. Thank you for joining us for week 5 of our webcast series on COVID-19, which explores various themes and topics impacting our larger community. This evening's webcast is on the topic of how COVID-19 will change the future of oil and gas. And our speaker is Michael Cohen, who is BP's chief U.S. economist and head of oil analysis. Today's topic is of global interest, but of particular relevance to Houston as the energy capital of the world and the impact of the pandemic on the oil and gas industry and the Houston community. Our moderator for this evening is Eddie Allen, co-founder and senior partner of Eagle Global Advisors, an investment advisory firm. Eddie serves as chairman of the Asia Society Texas Center. Before I hand it to Eddie to start the discussion, a quick note that following the conversation, we'll be taking some questions from viewers. So please share your questions throughout the discussion via the Facebook and YouTube comment box. Thank you.
Well, great. Thank you very much, Selena, and thank you, Michael, for joining us. It is a crazy world out there, and especially crazy in the oil markets. We've seen an unprecedented decline in the price of oil this year from $60 at the beginning of the year to $15 yesterday, with a brief trip to negative territory last week. What's causing this, Michael? What do you see, are the main reasons why this is occurring? And do you see prices going negative again in the near future?
Thanks, Eddie, and thanks to the Asia Society of Texas for hosting me. It's a pleasure to talk to all of you across the world about what really are unprecedented times. And so, Eddie, to answer your question, I mean, these demand shocks that we're seeing, the reduction in traffic, reduction in use of cars, the reduction in use of airplanes, and the cancellations that we're seeing is really something that we've never seen before. And so one of the things that we do at BP is prepare the statistical review of world energy. So this is history going back to 1965. And when we look at the effect that we're likely to see just in the second quarter from oil demand, oil demand is likely to go from roughly 100 million barrels a day down to 75, 76 million barrels a day, according to IEA forecasts. And we could see roughly a 10 million barrel a day decline just for the entire year as a whole, again, based on IEA forecasts. So based on that, very, very long history and the work that we do, that brings us back in the second quarter to levels that we saw, in the mid 1990s, late 1990s, and for the year as a whole, it brings us back into the early 2000s. So this is really unprecedented in terms of the demand shock. Hopefully, April will be the worst, and hopefully the second quarter will be the worst of any quarter this year. And hopefully that demand will start to rebound. But the problem that the industry is facing, and the reason that we're seeing such dramatic market impacts, especially as we saw about a week or two ago for WTI, is simply because the buffers that the oil industry has built up in order to match supply and demand are basically filled up or spoken for. So those storage buffers that are there in order to match supply and demand are basically seeing such a rapid increase in their use because of this dramatic imbalance between supply and demand that they are filling very rapidly. And in some cases, supply can't shut in fast enough. And so that's why one of the reasons why we're seeing the negative prices. I think there are a lot of other things that are happening, including retail flows, short-term mechanisms, the nature of the market participants that are involved that are also contributing to that. But the underlying fundamentals here are that simply that there is no place to put those molecules. And in the absence of of a place to put them, the price has to go to zero or to negative in order to find a willing taker of that molecule or that contract. So fundamentally, this is about adequacy of storage logistics, and in the absence of that, even possibly in June, we could see negative pricing again. If not in WTI, then possibly even for the dated Brent contract.
Wow. Well, I guess what's surprising to a lot of casual observers of the oil market is that you didn't see a supply response even when oil fell 50% from $60 to $30, and that oil has to fall, to these extremely low levels to cause a supply response. Why is that?
Well, I mean, look, there are a lot of logistic challenges. Producers don't want to shut in their output. In some cases, they still have to pay royalties. In some cases, you have foreign exchange effects that shield the lower oil price. In other cases, if the perception is that prices are going to rebound in short order, why shut in production immediately? So the real pressure to shut in isn't necessarily just because of economics. It's more because of logistics. If you don't have a place to put that barrel of crude, and that is happening in places like Canada, it's happening in Texas, it's happening in parts of North America, but it more importantly is happening in places like Brazil or Nigeria or Iraq, where there's just no physical place to put it. Even if there is a barrel of spare capacity to put that crude in China, for example, it's going to take too long to get it there, and there's no willing buyer, there's no refiner that's willing to take it, and so therefore that has to get shut in. And so we're starting to see that, and I think it's important to sort of delineate between these short-term shut-ins that are mainly a result of logistics and also because of the price falling below the operating expenditure or the operating cost of crude, and what we are seeing for the medium term, in other words, the next 6 to 18 months, which is a dramatic reduction in capital expenditure plans in North America and across the industry. So IHS estimates somewhere between 30 to 40% on a global basis. I've seen estimates by others just for shale that are up to about 40 to 45%. So those capital expenditure cuts are going to result in lower output. But the problem is that it may take too long for those barrels to come off of the market. And that's why we're seeing prices react as they do.
Well, where do you see, the supply does have to, decline to this 75 million barrels a day consumption when storage fills up. Where do you see, who's going to take the brunt of that? In particular, is it going to be North American oil, Canada and the US shales, or is it going to occur overseas?
Well, so I think for the most part, the majority of the shut-ins in the short term are going to be in the United States and Canada. I'd say about 2/3 of what Wood Mackenzie and others are tracking out there in terms of announced shut-ins is mainly in the U.S. and Canada. And so oil sands producers, mining, they have announced that they're both because of supply chain issues, coronavirus related issues, also because of price, and also because of logistics, that they're shutting in that supply in the short term. In the United States, it's stripper wells that are producing less than a very low amount of barrels per day. Some of that production has started to get shut in. But I would say by and large, based on what companies have announced so far, the total amount is still small. I think that as soon as we're through this upcoming earnings season, more shut-ins will come to light. But I think what we've seen over the course of the last 3 or 4 weeks, based on high frequency data, is that anywhere from 400,000 barrels a day to 600,000 barrels a day in tight oil basins, a reduction in production from those places. So I think the big question going forward is, will that be sufficient? And if we're already seeing the trough of refinery runs in the United States based on the latest EIA statistics, then we may have been able to catch a break here in the United States in terms of the need for additional shut-ins. It remains to be seen, obviously, over the course of the next 2 months, if we see additional lockdowns and additional government measures to keep people at home, or the uptick is slower in some places than what's currently expected, then that obviously creates additional pressure. But at the same time, OPEC countries themselves have pledged to take off 9.5 or 10 million barrels a day, depending on what your baseline is. So the OPEC countries have as well as Russia, have a significant amount of leeway in terms of their production levels. Obviously, the market is going to doubt the level of compliance that they will have, but there's a significant amount of flexibility that they have as inventories begin to draw again.
Well, I personally think it's going to be a little quicker in the U.S. This 400 to 600,000 barrels that you mentioned. I was on a call today with a private equity sponsor, NCAP, of a lot of private equity oil companies, and by the end of May, they announced that all of their companies will have no rigs drilling, in across their portfolio.
Yeah.
And I guess a lot of people heard Harold Hamm indicate that in the Bakken of North Dakota, that he'll have no rigs drilling, and so that should have a pretty quick impact on supply.
Yeah.
One thing that's gone on, though, as well, has been a lot of gyrations with OPEC and Russia. You alluded to back in March, as the demand destruction was becoming apparent, to pour gasoline on the fire. Russia and Saudi Arabia got into a price war where Saudi Arabia announced it would increase their production by 2 to 3 million barrels, and Russia decided it would do so as well. They've backtracked and come to this new agreement. But that breakdown in the OPEC and Russia cooperation spooked a lot of investors and has raised questions about have they changed their strategy going forward, possibly to maintain market share. They've been ceding market share to the U.S., basically. What do you see going on with Saudi Arabia and Russia?
Yeah, so it's a great question, and I don't think that there are any easy answers. The classic refrain for anybody that claims to know, what is in the minds of what the leadership in those countries or any OPEC countries is commonly those who talk don't know, and those who know don't talk. So what I can say is what's been publicly reported, and what I can say based on our best assessments, and that is that yes, we endured a price war. It lasted for 1 month, and then those countries within OPEC and of course their partners within the OPEC plus Vienna alliance all realized that a price war in the face of an unprecedented demand destruction, as you said, throws gasoline onto the fire, and there was no buyer for that incremental barrel of crude. It may have worked for a month, and we're seeing the impact of that in terms of a lot more Saudi barrels of crude heading here to the United States. But at this point, I think it's clear that that's not a long-term change. I think it does tell investors that a price war can happen if the right circumstances are there. So going forward, the unthinkable did happen. It happened for a month, and now that's an additional risk factor that any investor into U.S. tight oil assets, into anything has to take into, any energy asset has to take into account that is a possibility. But I think going forward, what OPEC has said and what Minister Novak has said is that they will continue to target the same kind of metrics that they've had in the past, whether that's a higher market share, getting back to where they were, for example, in 2016. So maybe 17% market share for GCC OPEC countries. Whether that's getting back to a 5-year average or a 7-year average or normal, however you want to define it in terms of inventories. It's clear that on a long-term basis, what we have written about within my group, within group economics, is that what really determines the ability of Saudi Arabia and of other key producing countries is their ability to reform their fiscal situation. And so at this current stage, IMF fiscal break-evens are upwards in the $80 to $85 range for Saudi Arabia. Now, that doesn't mean they're going to target 80 to 85 because there's a healthy bit of paring back that they can do. But it is important to understand that over the next decade, what really drives the price level is going to be their willingness, their ability to reform and diversify away from oil as the primary source of revenue. And the speed at which they do that is going to determine how willing they are to target inventories and prices going forward.
Well, I can certainly tell you that they recently floated shares in Aramco, the state oil company, and the news was not well received by those new shareholders of Aramco. If they want to sell any more new shares, they're going to have to get a higher oil price. But one question that's really, perplexing some folks is what happens, in the medium term? What happens when we come out of this COVID crisis? People are learning to video conference. People are learning perhaps to travel less for business. People are perhaps learning to be more comfortable, not commuting to work and working from home more. Have you guys started to change your outlook for, oil demand in the medium term to perhaps longer term from effects from this COVID crisis?
Well, yeah. So I think one of the unfortunate results of the coronavirus is that BP had planned to release our energy outlook just this past week, and we've had to postpone that because we're enduring what is an unprecedented shock to energy markets. And so we are going to take the benefit of a couple months more to review and refine and improve upon our projections that were basically pretty complete all the way up until the coronavirus happened. And so some of the things that we and many of our peers are going to be looking at include many of those issues that you raised. What are the behavioral changes that will be more enduring? What are the economic changes that will affect the baseline from which we recover from this crisis? I think just even before that, in the short term, we will definitely use more plastics for sanitary and health related reasons. We can already track based on high frequency data out of China that the Chinese are less willing to be using public transit, more willing to use ride-hailing services. So I think it's very unclear just how permanent those short-term factors are. Then once we move into the long term, we have to be careful to quantify just how much we're talking about in terms of how much a working from home, a more frequent working from home measure might do, or that behavior might do. So, in the United States, we see, I think it's roughly 15% of the US population has the ability to work from home. And then of that 15%, of that 15% of the population, they were working from home roughly 4 to 5 days per month. So now if we assume that that increases and we translate that into the rest of the world, which is a risky assumption, you're talking about not a huge amount of road fuel demand that is saved. It's not insignificant, but it's also, in the range of maybe 3 million, 1 to 3 million barrels a day, depending on how you look at it. And so over time, when we look out to 2050, they're not significant changes, but they could it very likely make a big change to what we had formerly looked at for 2030 or for 2040, for example. I think in terms of airlines,
so you do see peak oil demand is still ahead of us. You still see a higher oil demand for the world within the next 10 years.
We do. I mean, look, we haven't published our new outlook. I look forward to coming back and maybe talking and discussing with you our long-term projections when we release them in September. But based on our prior forecast, which included a less globalization scenario, we still see a rising population that demands more income, demands more energy intensive services, and demands more fuel, not just road fuel, and not just aviation fuel, that is going to need more oil over the medium and long term. So it's clear that we get back onto a lower path as a result of the coronavirus. But based on our prior projections, we still see a plateau in oil demand in the 2030 to 2035 timeframe.
Well, the bulls in America had seen the growth in world oil demand being met by U.S. supply. Where do you see North American oil in this, upturned oil world here in the next 10 years?
Yeah, so I think an investor in oil and gas right now, I think, has to worry primarily on two things. Already any investor has to consider the place of oil and gas amid the rise of new energy sources or clean energy sources. And I think now this, basic instability within the OPEC structure and the volatility that can come as a result of this new OPEC structure, and the effect that will have on oil prices, is also going to bring a little bit more doubt into investors into the shale patch. I think that it's important to understand that over time, obviously, there's a very important asset base in shale that plays a very important role in the refining system in the United States, and increasingly over the last several years, it played a very important role in complementing other sources of oil across the world. It was useful and fit and continues to fit for where that incremental demand is going to come from petrochemical related demand over the future. And so shale is very and the type of oil that comes from shale is good for that. But I think at the same time, given this price reaction that we are living through right now, and the plans to reduce capex, we're going to be starting from a much lower base. And that will mean that while U.S. tight oil and tight gas can continue to grow, obviously at slightly different paces, it's going to be from a much lower base, which will mean far less utilization or far lower utilization rates at the midstream assets and the export facilities that had all been built with a 13, 14, 15 million barrel a day industry in mind. So it's going to be a much lower starting point than before. It's not to say that we can't get back up to that. It's just that over the next 2 to 3 years, those companies need to be able to prove that they know how to, improve the returns back to shareholders. and that they know how to deal with the incremental spending that has come as a result of the very high decline rates at those assets. So all of that has to be taken into account, and I think that those companies have to prove themselves over the next 2 to 3 years before they're going to be able to spend in excess of cash flow again to get those kinds of growth rates.
Well, from the investment community, I will second your statement there. I mean, before the oil price crash, there was a lot of frustration and with the managements of U.S. oil companies with their inability to produce free cash flow or acceptable returns of capital in a $50 oil world. So
Right.
with the threat of price wars on the horizon, definitely the U.S. oil industry is going to have to up its game going forward. Now, you
Yeah.
mentioned natural gas, though, and a lot of people forget to think about natural gas. And one interesting result of recent events has been an increase in the price of natural gas in the US. Natural gas for delivery in December is up about 20% from the middle of March. However, overseas, the price of natural gas is down. Why is that going on? And what's the implication for things like the export of natural gas in the U.S. via LNG to the rest of the world?
Right. So it's another great question, and I think the main way to think about it in very simple terms, because I realize and I want to acknowledge that we have many different levels of expertise of people listening in on the call tonight. So I want to try to make this more simple. You know, at the root of this, the reason why US natural gas prices have gone higher relative to other prices of natural gas in other places is because a significant share of the growth in US gas supply over the last several years has come from oil. So when oil is produced, some of that associated natural gas has been marketed and has been a primary source of growth. So if the assumption right now is that US supply from an exit to exit basis is going to be down anywhere from 1 to 1.5 million barrels a day, based on certain estimates, most of that is also producing some associated natural gas. So the supply situation in the United States is contracting dramatically, and US natural gas prices therefore need to remain high enough for producers to be willing to jump back into dry gas plays. What's happening outside of the United States is that in Asia, we have much lower demand. China averaged roughly 40% of their LNG demand grew by roughly 40% between 2016 and 2018, but grew by just 10% in 2019. So that it was already contracting outside of the United States in terms of the appetite for natural gas. And when we were looking at Europe, we started the summer with very high natural gas storage levels that were 30% above where they were seasonally. And at the same time, an interesting conundrum is that, or it's not really a conundrum, but an interesting dynamic is that emissions prices have been declining in Europe as well. So that means that the cost to generate electricity from coal has been declining, which means that natural gas prices need to move lower in order to compete and get the same amount of coal to gas switching as what they would have had emissions prices not fallen. So all of that, in addition to the mild winter and the storage situation and the lagged nature of oil-linked natural gas contracts, has meant that there's this wide divide between higher relative U.S. natural gas prices and gas prices in Europe and in Asia. So what does all this mean then for if you are a possible seller of LNG into the world markets? It means that your incentive to sell LNG into Europe, or your incentive to sell LNG to Asian markets or even to Latin American markets therefore contracts. That arbitrage is no longer there. And so that natural gas will therefore, you'll see lower utilization rates for LNG plants going forward.
But what do you see for LNG in the longer term? You said you saw a plateau for the world demand for oil in that 2030 to 2035 period. What about LNG? It's been called the transition fuel to a renewable future. What's the long-term view on LNG?
Yeah, so I think this is an important question. I think that we depending on the scenario that we published back in our energy outlook, had suggested that gas would retain its share of the fuel mix, no matter whether it was a rapid decarbonization scenario, in other words, a 45% reduction in CO2 emissions, or whether it was what we called an evolving transition scenario, where you have much more increase in prosperity and much more increase in energy demand. So in both of those scenarios, in the what we call the ET scenario and in the RT scenario, the share of natural gas in the fuel mix is roughly the same, about a quarter of the total fuel mix. When you look at oil in those projections, 27% in the ET scenario versus around 20% in the RT scenario. Now, the question is more complicated when we look at more deep decarbonization scenarios. So in a world where we need to achieve net zero, or where we need to achieve a temperature change of no more than 1.5 degrees rather than 2 degrees, the role that natural gas plays starts to take a hit. And so in that sense, we start to see more of the use of natural gas for blue hydrogen, for example. And we start to see renewables take on a much larger share. There's more role for CCUS. And so in order to get to net zero by those timeframes, we need a whole suite of different technologies. And natural gas, unfortunately, loses out in those kinds of scenarios.
Well, but again, what about what time frame are we talking about here? I mean,
so still over the course between now and 2040, which is still quite a ways away. We're talking 2 decades away. Natural gas retains its share, and there are certain countries where it remains quite a prominent part of the fuel mix. In other places where there's policy to ensure, either because of a higher carbon price or for other means, then the natural gas tends to fall out of the mix as we move into the 2040 to 2050 time frame.
Well, now let's talk a little bit about renewables. You mentioned that, interestingly, coal is becoming more economic in Europe with these low prices of natural gas. Many people always have said that the cure for the low price of oil is a low price for oil, that it'll spur demand. Will these low prices for hydrocarbons enable hydrocarbons to capture more share in the energy bucket? And will it slow the adoption of renewables, in your view?
So I think there's a lot of ink being spilled on this question of the competitiveness of these of hydrocarbons versus clean energy sources, and I think that in the short term, it's very clear that there are cases where those clean energy sources, because of their role within the electricity mix and their reliability that they bring, enables them to continue to compete head-to-head with hydrocarbons. It is the case, of course, in the short term that in Europe, for example, or in Asia, where natural gas prices are lower, where it will therefore make it harder to compete with hydrocarbons. But in the United States, if we start to see this development where Henry Hub prices, for example, move dramatically higher because there's a need to incentivize dry gas drilling, that higher natural gas prices will incentivize the dispatch in the merit order of renewables. I think that it's important to understand that broadly speaking, and the IEA wrote a nice report on this today. When you look at where clean energy, renewable energy in Europe has basically taken on a bigger role than other sources of energy, whether it's because of reliability concerns, staffing, labor issues. And I think that this goes back to this important point to make about how clean energy or what is the attractiveness of clean energy over the medium to long term in a world where you have the ability to have a more stable source of energy that is competitive on its own right, and provides a long-term stream of stable, albeit maybe lower, but still stable returns that a government can rely on in times of disruption, that doesn't require fuel purchases and doesn't require the same level of labor. So I think in the short term, there's going to be supply chain problems with getting solar panels and wind turbines in place, but I think that's going to be temporary.
Well, now BP made a big announcement this February that you were going to become a zero emission company by 2050, and your goal for the company was to help the world become a zero emissions world by 2050. Does this radical change in the oil markets affect that goal or affect that view?
Well, yeah. So, I mean, it doesn't. And I would say, just to clarify, on our website, we list out exactly the 10 aims that we have. The first 5 aims that we have in terms of net zero ambitions are to ensure that the upstream production from our assets is decarbonized, and that we reduce the carbon intensity of what we are marketing, that we rapidly reduce the amount of methane emissions that we have within our system. And so there are a number of different aims that we have that we believe we can bring about through various technologies, different portfolio management, and things that we can do to the assets that we have in order to decarbonize their footprint. It also includes, investments in natural climate solutions. It includes investments in CCUS, and obviously ramping up our investments in clean energy. And so we have a very long-term investment horizon. It spans for many industry cycles, and including the industry cycle that we are in right now. And we firmly believe that the trends that we see, the pressure that we see by our shareholders and shareholders in companies like ours to decarbonize are going to remain present. And so I think that this instability that we're living through right now arguably makes the calls for an even faster transition even louder. And I think that if the population believes that we were unable to prepare for the coronavirus, and the public, this is a public good to have public health, just as much as it's a public good to have cleaner air and to mitigate the effects of climate change, then it's possible that governments will have more authority. States will have more authority in the society that is to come. So those demands to change are going to become even louder. And I think that if this experience that we're living through right now is one where commodity prices are very volatile, and if oil prices can be seen as even more at the whim of what OPEC or Russia or OPEC Plus or whatever institution that you have, companies like ours maybe shouldn't should attempt to diversify the sources of our revenue. And I don't think I know that we are not alone in that. And the
Well, I
final
should
point
point
that
out oh yeah, sorry, go on. Your logo over your
sorry, yeah,
shoulder is aiming for
yes,
zero. So you
yes,
definitely are putting it out
yes,
there.
yes. And I think the final point that I would make that our chairman highlighted in a Financial Times editorial in the spring is that, we have to plan, we have to invest, and we have to develop alternatives, because we don't know at what point we're going to radically have to shift course. And it's better and more prudent in our view, in our company's view, to do that with investments now than to suddenly have to do that at some point in the future at a higher price tag. And so that's the philosophy that we've adopted at BP, and part of that is taken from the work that we do within our team to do forecasting for, in the energy outlook. We believe that rapid transition scenario is one that is just as likely as an evolving transition scenario, and we have to plan our company around that.
Well said. Well, I think we have a number of questions coming in from the audience here. Let me go to some of the audience questions in the time we have remaining. James asks, after consumption comes back, how long will it take for drilling and exploration to ramp up again and supply to ramp up? I have heard some observers say that, you talked about this huge CapEx reduction today and in probably 2021, but some people say that's setting us up for a very tight market in 2022 or 2023 and a potential oil spike. What do you believe?
Yeah, so I mean, I think it's very defendable, and very likely, that is a scenario that could play out. When you think about the decision to shut a restaurant, it's much easier to shut a restaurant than to reopen a restaurant. And the same thing goes for a rig, and for any capital that's going to need to be deployed, or any kind of structure that's going to need to be deployed. You're going to need to find labor that may have gone to another sector. You need to staff it. We ran into the same kinds of issues with trying to staff up, and ramp up drilling activity in the aftermath of 2015 and 2016. So really, it's less a question of whether, the supply is going to be there. I think over time, the real question comes down to the demand trajectory, and just how permanent is the flight cancellation, how permanent is that working from home behavior, how permanent is the Zoom or Microsoft Teams or you name it use. And so that's something that's extremely difficult to quantify. If we're in a world where demand growth rebounds, back to where we were at the end of 2019, and that happens by the end of 2021, then it's clear that inventories will draw pretty dramatically. If, however, we're in a world where demand growth is quite low and never gets back up to the 100 million barrel a day range, then in 2022 the permanence of supply destruction won't be as big of a deal as in that other world. So I think it really comes down to the industry is flexible in its ability to supply. It really comes down to a question of the permanence of demand destruction from this.
James asked a follow-up question. When you shut in these oil fields, is there a permanent damage? Is there a difficulty in restarting them?
In some cases, yeah. I think, obviously it depends on the specific asset. In some cases, it depends on the reason that it was shut down. Was it shut down or the nature of why it was shut down? If companies are having to shut it down very quickly because of a logistics constraint or because of the inability to staff it because of the coronavirus in some way, shape, or form, that could lead to a slower restart than if a company was able to take 2 months and take more care in shutting it down. So that's the real difference. And it also, in cases like the oil sands, heavier oil tends to be more difficult to bring back on, far more energy intensive. And ultimately, it's going to be dependent on the OPEX curve for that supply that's been shut in, because depending on the commodity price backdrop and in the commodity environment that we're in, a company may decide that it doesn't make sense to start flowing that output again, depending on the specific circumstances.
I have a couple questions here. No surprise, since we're in Houston, asking about the job impact of the downturn in energy. How severe do you think that's going to be? I think especially in North America and Houston in particular. And will there be some sort of shift in demand in the energy job market, from trading to operations, say once we come out of this? That's asked by Matt.
Matt, I wish I had a good answer for you on that. I don't have specific figures for job losses. I would recommend the Dallas Fed, I would imagine, has done some work on this, in quantifying the number of energy jobs in the region. I think that there are certain companies that are clearly going to be worse off with weaker balance sheets and than others. But I don't want to speculate without having numbers at hand. So I'll take a pass on that one.
But traditionally, unfortunately, services often takes the brunt, the biggest brunt. And if you're probably closer to the wellhead, unfortunately, that's a worse place to be, wouldn't you say?
Yeah, I would say so. I think the market cap of service companies has been, very, it's been hurt pretty severely in this downturn.
An understatement.
Yes.
Kyle asks, in the near past, being a pure play Permian E&P company was viewed very favorably. Do you both think there will be an advantage for companies that have exposure to Brent pricing in the mid to large cap or in space? Or I guess that's a good, interesting question. Brent versus WTI is kind of what he's asking, I think. Will there be a widening differential between the two?
Well, I think to break that question down, first off, I think there's still value in the optionality that a shale asset brings, and the short cycle nature of it, and the quality of that crude and its proximity to the Gulf Coast refining center, and it's the pipelines that have been built up over the last several years to get it to the refining and export center. So I think there's still value in that. The question is, what's the company, and considering, whether that company is able to show positive and improving returns. I think that's the question. In terms of, Eddie, to take it to the next step, in terms of the spread between Brent and WTI, in a world where U.S. supply is lower by 2-3 million barrels a day, it's not a leap to surmise that that's a world where the onshore portion of the Brent WTI spread is quite narrow, and also where the offshore or the coastal to Brent spread is quite small as well. So I think for both of those reasons, a narrower spread could be possible. But we don't really talk about specific numbers in public settings.
Well, it's also the case too that, I mean, WTI is the price in the middle of Oklahoma, and right now it's probably being pressured by the storage considerations, the filling of storage at Cushing, and so a lot of technical issues go into that differential.
Right.
Yeah.
Cushing is the lowest cost place to store it. So markets were telling you, bring it in, store it at Cushing for the last month and a half. And now markets will and are signaling the opposite, take it anywhere
Right.
but Cushing.
Right. Okay. A couple people have asked, Jeff and me have asked about the potential impacts of government proposals to help the U.S. oil industry. Do you think any of them are viable? And in particular, Jeff asks about the proposal in front of the Texas Railroad Commission to curtail supply in Texas, and that's actually been floated in some other states as well. I believe Oklahoma. And just a bit of history for those people on the call. I mean, the Texas Railroad Commission has nothing to do with railroads, or maybe very little. It really regulates the Texas oil industry. And back in the 60s and 50s, it did actually function as OPEC. It actually restricted the supply of oil and decided who had to bear the brunt of those restrictions. And people are floating that very old idea in this new environment here. What is your just general thoughts on these on that proposal and any other government proposals to support U.S. oil industry?
Yeah, I mean, it's very clear the view that the RRC is taking right now. I think you have 3 commissioners, one of which has very publicly said, that they are for this and has been very much behind the proposals to prorate. And the commissioner, Wayne Christian, has stated on Wednesday in an op-ed in the Houston Chronicle that he would not be supporting the plan. So I think at this point, while there's been a lot of concern and speculation about whether the RRC was going to do this a month ago, 2 months ago, I think at this point, again, with refining runs likely starting to rebound, we may have endured the worst part, and we may not need to see government be involved in a scheme to prorate. Many companies across the board expressed an aversion to that, and so I don't see the commission having necessarily being willing to, from a vote perspective, and willing to from an ability to prorate, and also from a need to do that for them to be moving forward at this point. But anything can happen. So we'll see if the pressure is still there in June, then it's possible. I think our take and our view is that well, I would say my personal view is that market principles have to work, and they are starting to work. And those market mechanisms have started to result in pretty dramatic declines in production, even without the TRRC reviving their 1930s to 1950s role in prorating. So we will see.
Another proposal that's been floated is to put a tax on Saudi Arabian imported oil. What would be the impact of that? How would that help the industry?
I think that it would, I'd be a little bit cautious in how I respond to that first. And I think just generally, there's a lot of different national security considerations that would have to be taken into account, and long-term ramifications to the U.S.-Saudi relationship that might result from that kind of policy moving forward. But it's not really BP's role to sort of opine on those kinds of policy measures. It's up to the federal government to make a decision depending on what it thinks is best. It's just, there's not much that they can do.
Well, isn't it also fair to say, I mean, the Saudis are only 12% of the world oil market, and if you put a tariff on only 12% of the market, well, there's still, 80% of the market that's out there that's untariffed, and it's hard to imagine that it really would have any impact at all on the world oil price or any of the, there'd be a lot of barrels that you could import into the U.S. That would not be subject to that.
Yeah, sure. I don't think that wouldn't help the flat price of oil. It
Right.
would probably do more to hurt the U.S. Saudi relationship than anything. So and that those barrels have already been contracted and they have a place to go, and a refinery has purchased them, or they're meant to go into storage, whether it's strategic or commercial. So what's done is done. There's not much point in that, and arguably the market is going to evolve, from the situation we're in right now. And in 3 months time, the market may look completely different, and who knows, those barrels may be needed here, and it will facilitate our ability, or the US ability, to export some barrel of crude to some other buyer that didn't want to take those Saudi barrels. So it's every one of those barrels has to be taken into account.
Right. And one final thing that's going on out there is the Federal Reserve is now purchasing corporate debt. And in fact, they set the rules so that the Federal Reserve could purchase the debt of some companies that were investment grade that have actually fallen to junk in March, many of whom turned out to be oil companies. What would this, if the Federal Reserve did purchase this debt, what would be the impact of that? Would that be a panacea for some of our U.S. domestic oil companies?
So again, I think the general sentiment around that plan tends to vary depending on the company. I'm not privy to our official position on that plan. I think generally speaking, we as an industry are keen to not be keen on those types of things because it stays with us for forever. And I think if you speak to to be frank, right? Like, you talk to different financial service companies and different banks that received funds during 08 and 09, or different help from 08 and 09. And it sort of has hung over them every time they go to the Hill. And I think we're averse to wanting that kind of that kind of support and that kind of thing hanging over us. And market principles, again, need to act. So again, I don't want to.
It's also fair to say that it would be more of a potential assistance to investors in these companies. It wouldn't necessarily trickle down to the employees or workers in terms of retaining employment. The companies are still going to have to react to market forces out there in the basic markets, right?
Well, yeah, but if investors are more willing because of that government help to fund, the next tranche of borrowing, whatever it is, then a company that otherwise should have fallen victim to the natural business cycle is now not. Then
Right.
then that hurts it can cause issues for the industry.
Fair enough. Well, we could go on all night, Michael, and I have to say there are some more questions that sadly our clock is up and we don't have time to get to. But let me thank you and And let me thank BP in particular for assisting us and allowing you to appear with us, and also for its support of the Asia Society. I should mention these Thursday night online seminars have this is the 5th one we've had in the series of our business and policy program, and we have another very interesting one coming up next week, next Thursday at 7:30 Central Time. Please join the Asia Society COVID-19 webcast on the impact on immigrants from COVID-19. The pandemic has had a disproportionate impact on U.S. immigrants, whether they work in jobs deemed essential or international students or face uncertainty with their work or business visas. Join us next Thursday to hear from Charles Foster, chairman of Foster LLP, one of the largest global immigration law firms in the country, who will be with us to share his thoughts on those issues. Until then, thank you very much, Michael, for joining us. And
Thank you, Eddie.
to everyone out there who listened in, and I certainly learned a lot and hope you did too. Thank you so much.
Thank you.
Mhm.